Thank you so much, everyone, for joining us. We should get underway. It's 1 o'clock, so fantastic. Welcome to Johnston Carmichael here to talk to us all today about employee company shares. So navigating quite a complicated topic, but hopefully provides a decent amount of clarity for our guests here today. So Andrew, I'm passing over to you first of all, aren't I?
Thanks, Leo. Before I hand over to my colleagues Ryan and Zita, who are the important ones here today, I thought I'd just give a bit of an introduction to Johnston Carmichael. As a firm, we have 11 offices across the UK, approximately 1,000 people. We have all the services you'd expect from a large accountancy firm: audit, tax, corporate finance, etc. What we also have that many large firms don't have is a team which focuses exclusively on the video games sector. That team's headed up by my colleague Ryan, who's sitting here with me, and I'll turn this laptop down to get a better view of him in a second, and myself. And our role in part is to manage the partnerships we have with the likes of UK Games Republic, Scottish Games Developers Association, etc., and also act as the first point of contact for many of our games clients, which range from small indie startups through to large AAA. Quite often, Ryan and I are the ones who are sort of introducing opportunities to clients, or maybe clients are faced with a particular issue and we're discussing potential solutions to that. The last few years in the industry obviously have been really, really difficult, and our clients haven't been immune to that at all. One of the things we've been helping companies with sort of during that time is how to attract and retain the best talent, maybe where cash flow isn't necessarily really, really strong. And one of the potential ways to do that is through company share schemes. And that's going to be the subject of the talk today. So I'll hand over to Ryan and then Zita, who can both introduce themselves, and then we'll get into the meat of the subject.
Good. Thanks, Andrew. Good afternoon, everyone. Lovely to meet you all. See some of you again. My name's Ryan Milne. I'm a business advisory director. I'm based here in our Dundee office, which I guess is our gaming hub. But ultimately, we do have, as Andrew says, 11 offices across the UK with clients all the length and breadth of the country. And as we were saying, just for those who joined a little later, I look forward to seeing some of you next week at the funding formula session in London next week. My job is to basically be a bit of a listener to our clients and listen to what their concerns are, what their opportunities are, and match them up to the 1,000 people, whoever the best person is, to help them with whatever that problem or opportunity is, whether that be internally here within our Johnston Carmichael, or whether that be as part of our wider gaming network that we've developed over the last numbers of years. So I'm that kind of focal point, but one of the people who I regularly get on the phone to and say, Zita, I have an interesting one for you. Can you give me some thoughts on this employee share scheme, as my colleague Zita? So I will hand over to her.
Hi. Yes, my name is Zita Duggan. I work in our entrepreneurial taxes team. Our team concentrates on two main areas. We help companies who have investors who are interested in claiming tax relief under the enterprise investment scheme. And the other main area that we concentrate is what we're talking about today, is employee share plans. I've dealt with employee share plans for over 20 years, helping various different companies put in new plans and helping them with any issues that they might get over the life of the plan. And I've got quite a bit of experience dealing with due diligence processes when a company is coming through transactions. So I have seen employee share plans when they've worked out brilliantly and the company's done amazing and the employees have all got lots and lots of money and everybody's happy, but I've also had a lot of experience of when things don't work out quite so well. And, you know, there's issues to be dealt with. So my plan today is basically to talk about certain share plans. There's lots and lots of different plans that the companies can do, but we were going to talk about why somebody would have a share plan, and then just concentrate on a couple of the main plans, and just have a quick look at how that particular plan works, what the tax treatment is, some of the advantages, and then just talk about areas to think about in a little bit more detail to help, hopefully, avoid headaches and problems in the future. And then going to finish off just on employee reporting, the employment related securities reporting. So firstly, why would anybody put in a company share plan? There's lots and lots of different studies around which say that employee share plans help company performance. It helps with retention. It helps with employee engagement. It's sort of, if you have a stake in the company yourself, you're much more likely to work that little bit harder. You're more likely to stay with the company, especially if the plan is for a particular result. You quite often have plans that are put in specifically because a company is looking to exit, and people are going to hang around and work really hard to get that, if they're going to get a stake in that. The other thing, as Andrew mentioned, sometimes companies don't have the cash flow to attract somebody who's really brilliant that they want to bring on, and competitors may pay a bit more for. But if they are offered shares in the company, it might be something that would tip the balance so that they would come to you instead of a competitor. And the types of plans that are around are pretty much, there are so many different plans that you may or may not have heard of. We're not going to go into all of these different plans. We're just going to pick some of the most typical plans, and we're doing it from a private company's point of view, rather than a listed company. Not that any of the plans that I'm talking about today can be used by a listed company, but they just come to it from a different angle. They've got different priorities. So we're concentrating today on private companies' priorities. So the first arrangement that I want to talk about is straightforward transfer of shares. It can be shares that already exist, or it can be new shares that are issued to employees. It's relatively straightforward. You just need to make sure that the registrar of members is updated to reflect your new shareholders. There might be company's house filings, but other than that, it's relatively simple to just do a transfer of shares over existing shares. For employees or directors of a company, it doesn't matter why they got the shares. there is something in the legislation that says that if you are an employee or director of the company, you are deemed to get those shares because you are an employment. So they will be treated as employment-related securities, whether or not you just think of yourself as an investor. There are a couple of exemptions around that, like father giving shares to his son, or a couple of other areas, but mostly if you are an employee, you will be brought into this legislation. And you will be taxed based on what those shares are worth and how much you paid for them. So if you haven't paid the full amount of what they're worth, then that difference will be liable to income tax. It can also be liable to national insurance contributions if it is classed as a readily convertible asset. That is broadly shares that can be traded. So listed company shares are always readily convertible assets. If you get shares on a transaction, if you sell your shares on a transaction, that would be a readily convertible asset. There's also some extra conditions, things like shares in a subsidiary of an unlisted company, they're automatically counted as readily convertible assets. And those sort of shares would need to go through payroll, and you would have to pay employers and employees national insurance contributions on those. Any growth in the shares from after acquisition, then that should be liable to capital gains tax. But there's a note that I'll come back to in a couple of minutes. The advantages, all the advantages that we've just talked about in the last slide, for share for equity that's given to employees, relatively simple. It's easy for employees to understand. It could be that they also get dividend income. So if the company's paying dividends, they can get dividend income by holding the shares. And advantages for tax treatment, if those shares are not readily convertible assets, you get an NIC saving. So it can be slightly advantageous. And you know, if it's you get the shares, you hang on, you sell, any growth, that would be liable to capital gains tax.
Zita, sorry, just to jump in there, I guess I'm just thinking of most of the examples we tend to see in this space are for key hires, I guess. So that's you know, whether it's like a CTO kind of role or something like that, where you know it's someone who is critical to the development of the game, or an aspect of the game that you know the founding team maybe don't have the requisite skill set in, and at the earliest stage you want to make sure that that person's bought in for the reasons that you were saying in that on that previous slide, Zita. But I guess this is probably one of the easiest, fastest ways to make sure that they're bought in from day one, particularly when you know there's not you know it's maybe someone's first game, for instance, and there's not actually any you know substantial revenue being generated yet. This is often one of the quickest and easiest ways to deal with it, and it's been quite effective as well, I think, in the ones that we've worked on.
Yeah. But with that, with giving the shares, you do need to think about things, and the areas that we, both Ryan and I, have come across that causes the most problems are things like the share valuation, how that is valued. You could be loss making, but if you've got investors coming in and paying cash, the revenue are going to look at how much other people are willing to pay. You can take a discount, but if other people are willing to pay money, even if the company is loss making, there is some value there, and HMRC will expect you to value it as such.
And Tita, sorry to jump in, just do you mind just kind of reiterating the reason why that valuation is important? Like why is HMRC so concerned about the valuation?
That is for all equity, that is what the tax is based on. So the tax is based on the value of the shares, because that's the only way they can work. It's how much those shares are worth, is based on that value. So
yeah, and it's possible, Zita, isn't it, to have a nil valuation in certain instances. But as you said, where you need to be really careful is saying, well, our company is essentially worth nothing now because we haven't got anything out there released yet. You do progress with a nil valuation, and then 2 months later, you maybe have a 500k seed round, and HMRC quite rightly are going to say, well, how could you have been worth nothing there when you've sold 20% of your shares for 500k 2 months later? So it's just been really mindful of all of the relevant factors when you're thinking about these things.
And the same is true of a publisher deal as well, I guess, because obviously if you've been working on this project, say 2 or 3 founders just working on this alone, not really paying themselves a lot because you've not got cash, bit of a side project, and would do something like this, and like you say, Andrew, then maybe 2 months, 3 months down the line, you manage, if you're very lucky, to get a publishing deal, then great. And it's just making sure that these things, I guess, are documented and agreed at the time, Zita. And that's often the key thing, is agreeing it now, rather than looking in the rear view mirror and trying to, validate a position that should have been clear, that was clear at the time, but maybe wasn't documented as such. So that's where it's important to do these things at the right time.
Yeah, because for these particular valuations, that it's supposed to be what it is. It's based on that particular point in time. It's not supposed to be hindsight, but if you come and you get a massive investment straight after, HMRC are obviously going to look at that. The next thing I've got on my list here is Section 431 elections. This is always something that I've tried and explain as easily as possible. It's quite complicated. Broadly, if you have shares in a private company, those shares will more than likely have restrictions, which means that they've got a value taken into account those restrictions, and a value where you ignore those restrictions. And if you ignore those restrictions, logically, that is a higher amount. And for tax purposes, the amount the shares are worth is based on the restricted market value. So if you were taxed, you would be taxed on the lower value, taking into account those restrictions. But when you come to sell the shares, so anytime that the restrictions lifted, which is normally when you sell the shares, then a proportion of the sale proceeds could be liable to income tax based on the difference between the restricted and unrestricted. So if you say the restrictions count for about 10% of the value, you would pay 10% less when you get the shares, but that 10% could be liable to income tax when you come to sell the shares. The way to get out of that tax at the end is to make a Section 431 election where you agree to pay the higher amount up front, and then when you come to sell the shares, everything's going to be capital gains tax.
Which is a preferential rate of tax, so there's the benefit there, Zita, yes.
Yeah, in the vast majority of cases. I mean, occasionally you can have shares where you can lose them, so you don't want to pay tax and then lose those shares. So you might not want to do the election, but generally it's worthwhile doing the election and getting everything to capital gains tax rather than having an income tax hanging around at the end.
And that's the whole point, I
Yes.
guess, going back to Zita, the whole thing about doing it right at the time, if you see what I mean, so that you've then not got unintended consequences down the line, because the last thing we want as advisors or our clients to feel is at the end of the day, with all this success of a potential exit or something like that, then there's that sour taste or bitterness because there was something that could have just been quite easily done at the time if it's picked up at real time. So that's where I guess one of the overarching messages from today is probably, if you are thinking about, you know, issuing shares or doing something like that, engage with your advisor as soon as possible so that you can actually put these steps in place rather than looking, like we say, in the rear view mirror to try and backdate some of these things.
Yeah, I mean, the Section 431 election has to be made at the date that you acquire the shares. It's got to be signed by both the employee and the employer within 14 days of acquiring the shares. It doesn't go into the revenue, but you hang on to it in case the revenue asks about it. But it's more likely that it'll come up on a due diligence, and they'll want to see signed Section 431 elections to make sure that they don't have to just worry about this extra income tax, which on a transaction would be liable to NIC as well. The other big thing that quite often is forgotten about when you are taking people on is you're very keen to take somebody on, but it's thinking about what will happen when that person leaves. So if you bring somebody on and you give them shares and then a year later they want to leave, how do you get those shares back from them? And quite often it's worth thinking about making amendments to your articles just so that you've got leaver provisions to allow you to take shares back from directors or employees that leave. Sometimes you can have different provisions depending on whether it's a good leaver, somebody's only leaving because they're ill or something's happened, rather than if somebody's leaving to go and work for a competitor, you pay them less. But you need to agree that up front rather than at the end when you're desperately trying to get the shares of them.
Sorry, Zita, I promise you this that we'll stop interrupting and
It's
adding
okay,
extra
right.
things in so you can actually make good progress with the rest of the slides. I guess one of the things I constantly tell a lot of my startup, early stage, high growth gaming companies is the value of a shareholders agreement, and you know that's where working with a legal advisor to pull that together. Going back to your point of, it's all great when everybody's coming on board and the sun is shining and everything's good, but it is then when, you know, say for instance one of the team gets a job at a AAA studio and can't give the same time as the rest of them. What will the four of you or three of you, two you do in that situation? So it's having these things written down, one in the articles to make sure that it's possible to do something, but then having an agreement there via shareholder agreement so that everybody knows the rules of the game that you're playing.
We've just had a question from Mark Fraser. I think this might be something you're going to come on to, Zita. So what about offering share options for good standing, long-standing members who get to 2 to 3 years tenure?
Yeah, they are. We're starting with shares, but we're going to talk about a different different ones where share options, yeah, you don't need to make any changes to the articles.
And so just before you go on to the next section today, I cannot emphasize what Ryan or support what Ryan said enough. We deal with clients all the time where, you know, we bring up these things and they, you know, it's when the sun's shining and say, well, nothing's going to go wrong. So, you know, it's going to be absolutely fine. So we don't need to draft all these provisions that take account of, you know, maybe things going not quite as expected. And those are the kind of situations where founding teams fall out when it isn't agreed at the outset, you know, what's going to happen with these things. So I would encourage, you know, anyone who's kind of at the earlier stage to have a good think about that and just make sure you're all clear on what happens when things go well, but also when maybe things don't go quite as expected.
Yeah. The other thing you might want to think about is having different classes of shares for different people. So you could potentially have non-voting shares. So you want the employee to benefit from an exit at some point down the line, but you don't want them to slow down any decisions or anything around the company, or you perhaps don't want them to receive dividends. You can have different classes of shares for different people, but that adds complexity, and you know, you need to talk to your legal advisors and your tax advisors just to make sure that it doesn't have any problems. The final point I've got on this considerations bit is communications, and again, with equity, this is always one of the biggest things to think about. Is you can think it's great, but you need to understand where the employee's coming from, what they think that they are getting into, and make sure that they understand exactly how it works. Share price can go down as well as go up, all of those different things that needs to be considered and understood by any employees or directors coming in. The next one is still on shares, but if you have already built up some value in the company and you have somebody that you want to bring on, they don't have the money to be able to pay what the current shares are worth, and they don't want to be paying tax on what the current shares are worth, it is possible to think about putting in what's known as a growth share, so that you say you can only get value above a set amount, and anything less than that. So if the company's worth £1 million today, and you want the employee to receive value if, say, the company gets to £2 million, then today you would think those shares are worth nothing. It doesn't quite work like that, which we'll come on to, but it can mean that you are giving them something that's worth a little bit less. This is definitely something where the articles will need to be amended, because you will need to create a completely separate class of shares that is just going to benefit above the hurdle. For tax purposes, they're treated exactly the same as share acquisition. It's you have to work out how much those shares are worth, and then if they are not paying that, they are taxed on the difference. And like I said, the advantages are it's generally that they're going to be lower than what the ordinary shares are. You can make it so they're non-voting, non-dividend, so it's just the capital, and you know, how you set the hurdle can be quite flexible. But if you are doing a growth share, HMRC, they will expect that to be a forward-looking valuation. They don't accept that growth shares are based on what the company is worth at today's date. they say that for these shares, you only get them because you expect the company to grow. So that expectation has to be built in to the valuation, which makes the valuation a little bit more complex and a little bit more expensive to do. And generally, both HMRC and when you're going through a due diligence process, generally they expect a third party valuation rather than the company doing it, unless you've got somebody that's like amazing at the company. They tend to put more clout on third party valuations because those valuations are a little bit more complicated. Everything else is pretty much the same as employee acquisitions, the share acquisitions, but more than. So Section 431 elections, you really do need to do a Section 431 election, because part of the advantage of this is that you are only doing the value after the restrictions have been done. So you want to do a Section 431 election up front. You definitely need to think about the treatment of leavers, and the articles will definitely need to be amended. And because they are a little bit more complicated, the communication is also a little bit more. Don't know if anybody's had any questions on growth shares, or do you want to move on?
You're all good.
We've had a question in the Q&A. I don't know if it's worth. I mean, this might have not been visible to you, but we have a guest asking if it's possible to get agreements in place where an individual is not an employee or a shareholder. Sorry, pardon me, my mistake. It's possible to get agreements in place where an individual who is not an employee or shareholder is entitled to a percentage of profits from a specific project. So not an employee, not a shaerholder, but entitled to a percentage of profits from a specific project in this case.
Do you want to go?
I was going to say that's sort of like it is possible to do, but my specialism is around employees, so it's probably more Ryan that's
To me, yeah, that's fine. Short answer is yes, Harvey, it is possible. The risks are, as Zita was saying, if that person is, say, a contractor and is like if it's walking and talking like an employee, then even though they're not employed, then HMRC might look at those shares as being captured because of employment for the same reasons that Zita is mentioning. And obviously because it's of profits, what's that suggesting is that it's you're incentivizing future future benefit, if you see what I mean, when the company becomes profitable. But if it's a case of saying, we know you're helping me out now, I've not got the money just now, can I pay you back when we get our 10% from the revenues when we start releasing the game, then that might absolutely be fine. That might be another model to get away from issuing shares, is looking at, for instance, revenue share model or something like that to recoup any outstanding balances. But more than happy to have a chat around the wider arrangements that you might be referring to, but hopefully a couple of suggestions in there as well that might help. Thank you for the question.
Cool. Right, and this is, we've moved on to employee company unapproved share options. This was something that somebody mentioned earlier, is instead of actually giving somebody shares and making changes to companies' articles and all the company filings that need to go along, you can just promise them that at some point in the future they can buy the shares at an agreed price. So you set a price, possibly what the share price is worth now. Doesn't need to be. You can say you don't need to pay anything, but we will give you shares at some point in the future. And they're typically set up with a set of plan rules. Generally, there's one plan rules, and then you have individual agreements underneath them. And it makes it so that it's easier to get them off the individual. You can sort of have it written into the rules that if they leave, they lose that right. It's just it's a simpler way of doing it without having to do all of the filings that you need to do if you've got a share plan. For unapproved plans, from a tax point of view, the promise itself, the grant of the options, there's no tax implication on that grant. But when they come to exercise the options, they will be liable to income tax on the difference between the share price at the date of exercise. So it can be, if it's on a transaction, then they are basically getting taxed on the full growth at that date, which would be similar to if it was a cash bonus.
Yeah. And sorry to jump in again. Mark Fraser's asked another good question, which is, can the options be linked to company performance as well as
absolutely? Yeah, absolutely. Yes. You can set up the performance conditions to the option plan based on whatever performance condition you would like. You can have it linked to the company performance, or you can have it linked to individual personal performance, or quite often we see time-based ones. So it can be the shares will vest and the employee will be allowed to exercise them, to make good on the promise after a year or 2 years, or a certain amount. So you can have 25% after a year, 25% after 2 years, and different times. The problem with doing that in a private company is they will be liable to income tax. It might not necessarily be national insurance if it's not a readily convertible asset at the time they exercise, but they can be liable to income tax, and it's a share, so it's the amount they're worth, and they might not necessarily have any cash to pay that income tax. It's what we call a dry tax charge. They're going to have to find the money from their personal money to be able to pay the income tax. And if it's not a readily convertible asset, that will be through their tax return. If they do exercise and get the shares and hang on to those shares, any growth between then and when they sell the shares is liable to capital gains tax. Generally, we see it that people exercise and sell at the same time, mainly because of that dry tax charge. So it would be, all of the growth would be liable to income tax, because there is no growth between exercise and sale. The company can get a corporation tax deduction based on it's pretty much what the employee gets taxed on. That is counted as a corporate tax deduction for the company.
Peter, can I just ask, I guess, in your experience, what's the balance between, we can obviously create pools of options here, and how much do you, see for key hires, generally speaking, and then, do you tend to see you know, certain percentages for key positions, and then more of a general pool as well for, you know, the wider team?
You do, but I mean, it is company by company, and sometimes it depends on investors and what investors expect. You can see generally there's amounts between 10 and 20% for general pools, but you can have key individuals that you want. You have to think about how much you are giving in share options, because that will dilute what you get at the end. So if you are giving 10%, 20% to individuals, that means that when you come to sell your shares, you're going to get 10%, 20% less than. But if it's somebody that you really, really want, then, you know, it's negotiation between the company, and each company is, you know, they've got different priorities, different needs. Valuation again on these, so it doesn't really matter what the value is when the options are granted, but you do need to think about what the value is when they are exercised. If it's on a transaction, it's dead easy, but if they're allowed to exercise before a transaction, then you need to know how much those shares are worth, because either the individual will have to pay the income tax through their tax return, or if it's a readily convertible asset, it will need to go through payroll. This is probably, I do more on EMIs than I do on anything else, because generally it is the best share plan that you can get if you qualify. It's a tax advantaged, an HMRC tax advantaged share plan. So HMRC approve it. They've got loads of tax advantages for participating in this particular type of plan. But to do that, you have to meet certain criteria. The company has to be a qualifying company, so it's got to be independent. It's got to have a qualifying trade. So lawyers and accountants can't qualify for an EMI. Banking, land. It was actually set up, the plan was actually set up for computer companies. So it was software companies that it was originally thought up for. But you need to take care about things like licensing and royalties, and how much that is, and whether that's homegrown and things. So you just need to be careful about the qualifying conditions for trade. It only applies to smaller companies, so that's companies with less than 30 million and less than 250 employees. The employees themselves have to be qualifying, so they have to meet working time requirements, which is basically 25 hours, more than 25 hours a week, or 75% of their working time, and they can't have a material interest in the company. So you can't have somebody that's got 30% or more in the company benefiting from an EMI plan. And there's certain requirements around options, and they've all got to be written, and it's less than 10 years. So you need to make sure that you meet all of these qualifying conditions. But if you do, the advantages are there's no income tax on grant, and there's no income tax when you come to exercise the option either, depending on, as long as they're not granted at a discount. So if the options are granted at the value the shares are worth at the date of grant, which hopefully is a low amount, and then they come to exercise later on at that price, however many years ago, then all that growth will be included as capital gains tax when they come to sell the shares. There's also business asset disposal relief, which is relaxed just for EMI plans. So you don't need to have 5%, and you can get down to a 10% tax rate for capital gains tax on your first £1 million of gains. And again, the company can get a corporate tax deduction even though the employee is not actually paying income tax. Things to think about, you can go to HMRC and you can ask them to agree that you meet the qualifying conditions. Well, the company meets the qualifying conditions, so that's the advance assurance. You can also, one of the biggest advantages of an EMI plan is you can get HMRC to agree the value of the shares at the date of grant, which is brilliant because it just means that you've got certainty about how much tax you are going to pay on those shares. I will just have a word of caution on the valuations themselves, because those agreements are only based on the information that you give HMRC. And if HMRC think at a later date they didn't have all of the information, then they can turn around and say, no, you didn't tell us everything, so that valuation doesn't hold up. It's something that you need to be very careful about telling them everything, even when you think that doesn't have any bearing on the value. You could be having the initial discussions with investors, but there's been no prices mentioned, there's been no nothing has actually happened yet that's going to have an impact on those shares. As long as you tell HMRC and you tell them why that has no impact on the shares, that's fine. But if you don't tell them and then they later find out, they'll turn around and say, oh, you didn't tell me everything. That doesn't hold. Changes to the plan as well. You've got to be very, very careful about changes to the plan. Some plans have discretion in them, and HMRC can turn around and say, no, that's a fundamental change to the plan. We're going to treat this as a new grant of options, and all that growth that you've had up to that time was basically will be lost. They'll count the new grant at the date that the change was made. Right, I will. The final plan I'm going to be talking that just mentioned briefly is company share option plans. This is what you get if you don't qualify for an EMI plan. So either companies that are too big or they've got trades that don't qualify, then you would go down a company share option plan route instead. They're not as flexible as EMI, and the limits are not as good as an EMI, and also you don't get the enhanced BADR relief, so they're not quite as good as EMI, but still £60,000 of the value at the date of grant, and any growth on those shares, any growth in value on those shares, is all liable to capital gains tax when you come to sell the shares. There's no income tax on exercise as long as you don't exercise before 3 years in most circumstances. There are a couple of times that you can get out of that 3 years if, for example, the company is sold. But generally you have to hang on to the options for at least 3 years before you can get the full tax relief. And finally, I just wanted to mention ERS reporting. This is something that can very, very easily be missed, where somebody is given shares, they've paid the full amount for those shares, there's nothing to tax on those shares, and companies don't report that to HMRC. It still needs to be reported to HMRC, even if there's no tax to pay. So the things that you do need to report are things like the grant of an option, except for EMI, I'll talk about that separately. The exercise, sometimes lapsing of options, cancelling of options, depending on whether it's under an approved plan or whether you got money for it. Acquisition of shares always needs to be reported. Lifting of restrictions needs to be reporting if you haven't signed a Section 431 election. You also need to report if your shares have been enhanced in some way. You could potentially have a tax to pay for that enhancement if you have got more than the shares are worth when they're sold. That could be taxable and also needs to be reported. For approved plans like your CSOPs, there's this share save as you earn plans and share incentive plans. If they are not reported within the deadlines, they are basically treated as though they're not an approved plan, and you don't get all the tax reliefs that come with that. For EMI, it's slightly different because for EMI, there's a separate notification that needs to be done. It used to be that you had to do that within 92 days, but that's now been extended. So it's the same reporting deadline as all of the other annual reporting. So it's 6th of July following the year in which anything happened. And I think that's covered. Is anybody's got any questions?
That's great. See, I was just going to say on the ERS reporting side of things, I think that's something. It can cost hundreds of pounds if you don't get it right, but it could cost you thousands of pounds. And we've got a couple of examples that we're working on just now where we are dealing with thousands of pounds, and that's just on, missed filings. And then there are legal fees, our fees that go alongside that as well. So it's, I guess, going back to my earlier point, and I note there was, a comment regarding the affordability of these things. And I think the thing I would say to that is probably look at this as an investment in the sense of if you invest in it now, it's going to cost you a fraction of what it will cost you if you do something like this and do it wrong. So, there's an example, like I say, that one of our clients has come over, and I was saying before the session, has been throwing shares around like it's confetti, and that's going to cost the founder a significant amount of tax plus legal fees of 5-figure legal fees, our fees plus penalty. So the key with all of these things and the whole session, I guess, is there are multiple different ways for you to achieve whatever the strategic ambition is to bring people on board. But the key bit is bring your advisor into those discussions, consult, and figure out what the best plan of attack is for you in the business longer term.
And whilst you have to absolutely make sure you're getting the right advice and getting it right, what I don't want to do, because I could sympathise with anyone on this call saying, oh my God, oh goodness, that's so much information, so many different options, so much terminology that's been thrown around there. But the worst thing you can do is go, well, that's just all too complicated, so I'm not going to do it. If you get the right advice proactively, that advisor should be able to guide you through it, hopefully in a cost-effective way, but also in a way that you fully understand what you're doing. So hopefully that's helped today, but we're more than happy to answer any other questions now, or if you have questions after the session you want to follow up, again, more than happy to have a conversation.
Fantastic. Yeah, no, thank you so much, Zita. Really, really appreciate it, and to both both of you as well, Andrew. I think what's fascinating is that there is an awful lot of options available, and that there's a lot of flexibility that's built into this, and ultimately, you know, these options are put in place. These options exist for a multitude of completely different businesses, completely different sort of business structures as well. And so actually sort of navigating this and finding the most suitable sort of array of options, I suppose it comes down to experience, you know, which like what you're saying already, is how people such as yourselves can really help sort of guide people through this kind of process. So yeah, no, thank you so much. I appreciate your time. I think in terms of I think from my side, I think it'd be really helpful to just sort of finally sort of just cover off some of the sort of key risks associated with sort of shares as options. I mean, obviously at the beginning you sort of mentioned about diminishing sort of control, I suppose, but there are ways, like you described, that you can limit that control and take that sort of diminishing aspect out of the equation, really. So I mean, aside from some of the fees, you know, what are the real sort of risks associated with doing this? Assuming you get it right, obviously.
Yeah, so I guess from a wider business context, the main risk of giving away too many shares is it depends on what your funding strategy is. So if you're going external investment rather than publishing model, for instance, and you're giving away more shares to the team away from the founding, say for instance, you're a 3-founder studio, and then you bring another person in, all of a sudden you're down to 25%, and then you're bringing wider portfolio of team in, and then all of a sudden, when you're then trying to raise external investment, the amount of control one individual person of that founding team has is substantially lower than what it was at the start because of so many people involved. So it's of that control nature that you're speaking, and that is where it's vitally important to have the right conditions attached to each of those shares, or the option plans you put in place are perhaps geared or incentivized towards the exit, so that ultimately what you're trying to do is get people to join you on that journey and then benefit at the final crescendo point, and in a tax efficient way, so that then you still have the control throughout that whole process. You're not giving away the shares, they've got a sense of ownership with the option, but they still get the benefit over at the end point, which is why the EMI scheme, as Zita was explaining, is the kind of go-to option that we would look to introduce wherever we can. But the risk, I guess, is someone falling out of qualifying is another area that Zita, I think you spend quite a lot of time on, is, for instance, if someone joins the scheme and then loses their qualifying conditions to get those during those 4 years, for instance. If you're,
so say, for example, if someone was working a set amount of hours and then dropped below those hours, Zita mentioned the 25-hour threshold, then you could have an employee who thinks they're getting share options and actually is no longer a kind of qualifying employee. So I mean, there is quite a lot of compliance to manage around it.
But there are tools out there that can help with that management. But obviously, that's where working alongside your advisor on that kind of strategy and keeping it tight is often the best way, particularly at the startup early growth stage. But as you get to bigger, wider business, then it can be a little bit more freer, and that's where I was kind of leaning on the general pools that might sit there for larger studios.
Yeah.
Anything to add on that, Zita?
Yeah, I think it is, if the keeping it simple is generally a good idea. It keeps the costs down and you know, helps people understand better. But things like valuations and the assurance, it is possibly worth spending a little bit more on those, because you can get those done quite cheaply, but they don't necessarily always achieve what you want. So yeah, it's just prioritizing what you need.
Yeah, absolutely.
Fantastic. Well, thank you so much. Really appreciate your time today, Zita, and obviously Andrew and Ryan as well. So thank you so much, everyone. Really appreciate it. It's gone 2 o'clock, so we are we're into maybe a second lunch now. So yeah, we should probably call it a day. But in terms of your contact details, I think everything's sort of on the Eventbrite. So I'll share that on the screen, well, on the screen on the chat for Harvey there, but yeah, did you have a final slide with contact details?
I think our names are in there on one of the early slides, Zita.
Yeah,
right?
Yeah,
And they've got email addresses in there as well.
Yeah, no worries.
Yeah,
I'll make
we've
sure that
got,
those are.
yeah, we've
Perfect.
got
Yes.
email addresses there. So
Wonderful. Well,
for
thank you so
anyone
much,
that's at
everyone.
the funding formula next week, I'll be there as well. So just come over and say hello, and I'm happy to answer any questions. Although I will just hold the right to say this is Zita's specialist area, and I will have to give her a phone. But yeah, I look forward to meeting you all next week as well. Thanks again, Leo, for hosting this great session as always.
Thanks, Leo.